Hello, Nick.
Good morning, Matt. How are you?
Very well, sir. Okay, so sort of very quickly, just give you a quick whistle-stop tour of Nick's career. He's been with Polar Capital since 2003, but has sort of 30 plus years of investment experience. About to say for the last 22 of them, he's been focused exclusively on global financials. Nick, obviously, we're here to talk about PCFT. Would you like to just give us, I guess, an extended elevator pitch? Tell us about the trust. Give us an introduction for people that are perhaps less familiar with it.
Yes, very happy to, and thank you for having me. Yes, just a quick plotted history for those who don't know the trust. We launched it back in 2013 as a low-risk way for people to get exposure to global financials. That initial version of the trust, or we call PCFT 1.0, had a fixed life of 7 years to May 2020. In hindsight, not great timing to the middle of one 100-year pandemic. At that time, we went to see shareholders. The trust life was extended, subject to regular 100% cash tenders every 5 years. So people had an exit opportunity back in April 2020, and there's a new one coming up in June. So, middle of next month, and we can perhaps touch on that a little bit in questions and how the structure is going to be slightly evolving going forward. So, team of five of us. So it's myself, it's George Barrett, Tom Dorner, who co-manage the trust, and we're supported by Nabil Siddiqui and Jack Deegan. So a lot of experience covering financials within the broader Polar Capital team. Other colleagues that focus on the sector, whether from a sort of sectoral basis, we have an insurance vehicle, or geographic. So there's a lot of resource there to play off. And how's the trust performed since, if you go over to the next slide, since the last tender offer? And this is what's really pleasing, is for those that supported us, 5 years ago, or bought in, shortly after the recovery from the pandemic, you've actually done really well in financials. So they've outperformed over, 1, 3, and getting up close to, 5 years. And whether that's against value indices or, global equity markets. And even year to date, with the volatility we've had in markets, financials are up, this is in sterling terms, just shy of 1%. Global equity markets are down around 6%, and US equity markets down. So that's very surprising. It's not often, normally you'd expect in a market sell-off for financials to underperform, reflecting their sort of cyclical nature. And this time they haven't. And I think that sort of will come on to why, I suppose, the sentiment towards the sector has been improving, why we think they're well positioned going forward for the next few years. So if we go over to the next slide, I just touched on discrete performance, and then over the next slide. So I suppose the key is, it's just a quick reminder, what are you getting when you buy shares in the trust? Global financials, second largest sector after technology. And on the right, we sort of peeled apart what's within the sector. People often sort of think about it as very banks dominated. Banks obviously are key, but X that, you've got, diversified financials. So that could be exchanges, that could be trust banks, that could be asset managers. You've got insurance, reinsurance at one end, insurance, life insurance, and so forth. And latterly, since the middle of 2023, payments has come into the sector. And so what that means is you've got different cyclical and sort of counter-cyclical, acyclical companies within the sector, from banks, which are obviously going to be more cyclical, sensitive to a downturn in markets or economies, to the other end, you've got payments and insurance companies, where they're very, very defensive. And so one of the attractions for us is being able to think about how we structure the portfolio depending, what we see going forward. And if you carry on the slide after that, it's giving you, the sector's giving you exposure to what we think are some, fantastic businesses. Things like, obviously, JP Morgan, American Express, the payment companies like MasterCard, Visa, Berkshire Hathaway, Warren Buffett will be speaking on Sunday at their latest AGM, so it'll be interesting to see what he has to say. But outside, some of those large incumbents that have huge moats, oligopolistic sort of characteristics, incumbency advantage that some of these big financial businesses have. There's a lot of other more interesting ones lower down, whether you look at, the banks, insurers, diversified financials, or payments. And that's where we're trying to find a little bit of extra alpha for shareholders and tomorrow's long-term winners. Though despite all the, I suppose, events for the last 10 years, it's amazing just how well some of the largest companies just continue to deliver returns to shareholders. On the next slide, this isn't new news, but I think this little chart does highlight the issue for investors today. Markets, as we know, are incredibly concentrated, both in the US and towards, a small number of stocks in one or two sectors. The performance year to date of financials, maybe that reflects similarities to 25 years ago, the TMT bubble. As we know, today is very different. Companies, the Mag 7, are very cash generative, have very strong balance sheets. So we're not saying that, we're expecting the sort of returns that you saw then. But it's that concentration there. And the risk is when markets decide to move and everybody tries to squeeze through that door into other sectors, whether it's financials or elsewhere, then you have that risk of violent moves. So you've got to be ahead of that opportunity and position yourself and think about diversification. The next slide, I suppose, is well known. Tone has been around in markets for more than 15 years. Financials by default is a value sector. Today they trade at probably around a 25% discount to wider equity markets. They've been as wide as perhaps close to 35% in the pandemic. And ultimately, it's low price earnings, low price to book, high dividend yields. But historically, value has had this fantastic track record of outperforming markets over time. And we've just gone through this fantastic period in the last 15 years where the opposite has been true. And that's a combination of really strong tailwinds for growth sectors, technology most notably, smartphones, cloud, latterly AI, etc. On the flip side, significant headwinds for the more value sectors in the market, like financials, whether that's being low or negative interest rates, regulation, and so forth. So we think the background for the sectors change, and that big change has been interest rates going back to a more normalized level. That's markedly changed the profitability of the sector, and consequently reflects why the sector's been performing really well over the last couple of years and why we think that's sustainable from here. Where do we see value? I mean, these are just some of the themes that we think are really interesting at the moment, and we'll drill into some of these in a bit more detail. The sort of allocation that we have within the trust. So US lenders, obviously US financials have benefited from, US exceptionalism, cheap energy, deep capital markets, a growing economy. But there's an interesting angle here about obviously regulatory headwinds now becoming tailwinds, not just in the US, we'll touch on that. Exchanges and platforms. So we've got more exposure at the moment to them. Again, beneficiaries of activity in financial markets, volatility as well, some of them benefiting from that. Also the growth of data. European banks, there's the phoenix that's risen from the ashes along with Japanese banks. That significant improvement in profitability that's come through there. We don't think that's completely recognized by markets. We think there's more to go for there. And at the other end, insurance, we like it. We'll go into that. It's counter-cyclical. And then more recently, we've been adding to emerging markets. Perhaps the surprise winner from what's going on with the tariffs at the moment. So cheekily on the next slide, so what's happened with the incoming Donald Trump administration? So the Consumer Financial Protection Bureau is now up and running, but the new appointee to run that, some of his first decisions was to tell them to turn off the website, to stop all investigations that are going on. Now, the website's back up and running. We're not saying that, the degree of sort of regulatory, we're not going back. The pendulum's not swinging back to what we had before, 2007. what we're saying is you're going to get a much more constructive relationship between financial companies and regulators rather than being the combative one that we've had before. And that has significant positives for the sector going forward around transparency, about capital return, about profitability, about overlapping rules that, just add cost. But not just in the US, you've seen it here in the UK and you're seeing it in Europe. Policymakers are belatedly waking up to actually how damaging some of the regulations are that have been put in place post-crisis. Put in for a good reason, but quite often, the level of technical detail and what that's doing to, perhaps put chains on underlying growth in economies is detrimental, and we need to find the right balance. So that should be, it's going to be, we see that as a positive tailwind going forward. On the next slide, just a quick check. What were valuations like pre-GFC? They were materially higher. We were certainly not saying they're going back to the levels of 3 times book, for US banks as shown in this. But what we're saying, in a more transparent and positive environment for the financial sector, then we think that helps reduce cost of capital. That helps reduce the environment for the sector to make improve returns from here, and one where actually people look at it for more positively and leads to higher returns going forward. Just on exchanges and platforms, just a couple of trends here on the left. Again, you go back 10, 15, 20 years, if you bought shares in NASDAQ or London Stock Exchange or Deutsche Börse, you're very exposed to the volatility and turnover of capital markets. So markets going up was a positive, markets going down was obviously a negative. A lot of these businesses have shifted, into data, particularly indices. So every time you buy a FTSE 100 tracker, a fee is going to London Stock Exchange, the same for the NASDAQ, and we can touch on S&P and MSCI as other businesses in this segment, but also just software. So they're much more, they're less cyclical businesses they were, and they continue to see, strong growth, that demand for, monetizing that data sets that they have and the services they can provide to their clients. On the right, just growth through the sort of democratization of saving, investment, trading. So we've put interactive brokers down here as an example, and we continue to see that go. Flatex de jure is another example that we've liked. And then sort of over the page, touching on European banks. I mean, they've done fantastically well over the last few years, reflecting that significant improvement of profitability. Interest rates going from negative to a positive number has led to margins expanding, to return on equity going up, and the share price has done well off the back of that. Now, despite that, they're still not far off historic discounts to the wider equity market. Today, it's very, very different to what it was 10 plus years ago. Across the banking sector, balance sheets are, significantly stronger. They have much more cash on their balance sheet, liquid assets. They're taking a lot less risk than they were 10, 15, 20 years ago. More regulation around mortgage lending or whatever it is, more of that, all those riskier assets that they might have lent against before, it's been pushed off banks' balance sheets. And you're seeing an increased return on capital through buybacks and dividends. And ultimately, if interest rates stay at a more normalized level, maybe in the Eurozone, that's 1.5% plus, then these banks are going to continue to make actually, good returns. And for that reason, we continue to like them outside, short-term volatility. And then on the next slide, onto insurance. So again, the insurance sector has benefited from the rise in interest rates. Insurers we like, they're less economically sensitive because claims are driven by accidents and weather-related losses. They earn their money two-way: one, from their underwriting returns, as long as the premiums they take in are more than the claims they have to pay out, and secondly, investment returns. So that float they keep there to pay claims. So with the rise in interest rates and bond yields, suddenly insurance companies are making more, making good money again. And at the extreme, we put here reinsurers, reinsurance rates have gone up a lot because of higher claims driven by more catastrophe losses in recent years. And even what we've highlighted here, even though you've started to see reinsurance rates start to roll over and come off this year, actually we think they're going to continue to make some good returns looking forward, and they act as a nice counterbalance within the portfolio from a risk perspective. Just looking further out very quickly, just some of the themes going on, which we can touch on in Q&A. We touched on some of this democratization, about savings and investments, but private markets. We had a big weighting to private markets at the beginning of last year. We've pulled back quite materially, because those businesses have done really well. But long term, we like that they continue to see strong inflows. As money shifts from public to private markets. Yes, there'll be volatility around their returns, but we don't see that ending anytime soon. Data monetization, we touched a little bit here. Artificial intelligence. Banks and insurers are the two, according to a report from Accenture, probably the two biggest industries that are going to benefit most from the ability to cut costs. It's all those processes, the data they carry. So again, we're starting to see some use cases come through of where banks and other financials have been able to cut costs, whether that's onboarding clients, whether that's AML. So again, an opportunity there. And then payments, again, great, nice, boring companies like Master and Visa, but also there's some new entrants that have come in like Stripe and Adyen that have, disrupted on the payment side, and others there. So that's always continues to be an interesting space. And then just to quickly wrap up the last two slides, valuations. This is a few months out of date. Obviously, we've had a correction. I mean, today financials are trading, 12 times. So within the range they've been historically, towards the upper end, as with everything in equity markets at the moment, but still on a big discount to global equity markets that are closer to 16 times. And if we drill down into financials, then banks are still trading at sort of close to 9.5 times, and some substantially less than that. So there remains a lot of value within the sector. And obviously, when markets are looking expensive, if people are worried about markets correcting, then the attraction of some of these companies trading at low multiples gives you a lot of downside protection. And then probably our favorite slide, just to wrap up, as we know, markets are a voting machine in the short term. What we're highlighting here is that shift between growth and value sectors. You can see, obviously, the bubble back in 2000 that reversed. It's almost in its entirety going into the 2007, 2008, and again we've come back to similar levels today. And we're not saying that we're going to go back, you're going to see that switch from growth into value going back to the levels we saw around 2006, 7, 8. But we're saying that piece of elastic is probably at some point going to, get pulled in. And at this point, that tailwind for value sectors, financials and others, actually it's a nice place to be certainly when there's volatility around in markets, as we see. So with that, just to wrap up, we think it's a really interesting time for the sector. It is outperforming despite the volatility in markets, which I think speaks volumes. And very happy to take any questions.
Okay, we've got quite a lot of questions coming on the Q&A,
Yeah.
so I'll just see if I can work my way through these. So we've pretty touched on this a bit already, but we've got a question from Sabrina, who says, how have American tariffs affected PCFT?
It's a very good question. I mean, directly, there's very little impact on the sector, reflecting the tariffs. The financial sector is not impacted from a business perspective, but it's second order effects indirectly. So what do tariffs do to growth, in the US and elsewhere? And what does it do to financial markets? That uncertainty. The consequence of that, you saw in April, as with other sectors, financials sold off, since rebounded, and that's the uncertainty. So within that, as you expect, actually insurance companies, the payment companies, some of the others held up, extremely well. Some of the banks, some of the asset managers got hit quite hard, bounced back quite
Yeah.
quickly to different degrees. So yes, I think ultimately it's unknown. We don't know what's going to happen. I suspect the most likely happening is we see more volatility over the next few months. If there's more, if it takes time to resolve some of the negotiations, and that will have an impact on the sector as it does with equity markets
Yeah.
globally.
Presumably this is all second order effects, isn't it? Because
But it
we're
is
not,
second order
it's
effects.
all services in essence. And is there quite a lot of what people are sort of referring to as local for local in a way, do you think?
Local for local, as in,
As in companies providing local services. So a lot of this stuff is not necessarily going across borders. Obviously, the big banks it will be, but
no, I mean, you would expect that the stocks will suffer most in the sector. To the extent that there's a slowdown or recession, that will hit the earnings of the banks, and maybe some of
yeah,
the more, those companies more sensitive to financial markets. HSBC had the results this week. I mean, they're obviously known for doing a lot of trade finance, and again, they put a number on what the loss is to them because they're obviously dealing with perhaps more
yeah,
trading like businesses, exporters, and so forth. So you obviously expect to see some losses pick up where businesses struggle depending on what happens with the tariffs. But in the grand scheme of things, it's pretty, it's
yeah. Okay, we've sort of got a question here, or a couple of questions relating to the sort of size of the stocks that you hold. So, obviously, we've had a look. One of the things, I think, was sort of slide 35 that we had here, just showed the sheer diversity of what's sort of within the financial space, and clearly, it's a lot more than just the sort of banks. But I guess how is the portfolio split in terms of sort of smaller, mid, large cap stocks? And the sort of question here is, would you consider going more towards the smaller end? What's the smallest size company you'd consider having in the portfolio?
Yeah, it's a good question. We are underweight. We don't have a breakdown in the presentation in front. We are underweight some of the very largest. I mean, today we don't have a holding in American Express. We're underweight some of the largest stocks globally. Slightly underweight some of the largest US banks. We are overweight some of the mid and smaller ones to a small degree. I mean, very much the last 5+ years, it's right to be overweight the large cap companies. Small caps, mid caps, with some exceptions, have struggled in that environment.
Yeah.
I think that again, that piece of elastic has stretched quite a long way. So you've seen M&A pick up. You've seen some M&A in smaller banks in the US. We've notably seen it in the UK as well. So we are selectively adding to some of our smaller mid cap holdings. I mean, I think the smallest one we have in the portfolio has a market cap of about 100 million. That's
Yep.
listed. We have a couple of unquoted investments that make up about 1% of the trust. So the main holding there is a holding in Moneybox, which is an ISA savings platform. We have a small holding in Asset Bank. But yeah, we've been much more selective. And I think maybe the outlook is perhaps looking a bit better for some of them going forward, just because that piece of elastic, that valuation has stretched quite a lot.
Another question on the portfolio here. Somebody's obviously been looking at the breakdown, but sort of really explain the rationale behind the sort of REITs positions.
Yeah, so when we launched the trust, real estate was part of the financial sector. And in 2016, big index compilers, including MSCI and so forth, removed it, and property REITs have had their own, created their own sector. We still have an interest in it. Probably, obviously, banks lend against property, so it's very important to understand what's going on in property markets. We saw an opportunity. We have one holding in Irish REIT, so it's Irish Residential REIT. It's a Dublin, effectively, apartments and apartment blocks. As with a lot of REITs, they sit on quite meaningful discounts.
Yeah.
Ireland's had some quite strict rent controls in place, and that's had consequences for development of new, house building and new apartment blocks. So they're looking at reviewing that. So we thought it was just a really interesting opportunity with a possible catalyst for that to be resolved. We've held Irish REITs in the past. There's another two, both being taken private, and that would be icing on the cake if that happened. That's not the reason for owning it, but we just thought it was an interesting opportunity.
Super. There's a couple of questions here that I think probably sort of go together. Somebody sort of said, what strategies are in place to keep the sort of trust discount narrow? And somebody said, can you talk about the sort of upcoming 100% tender offer?
Yes. So when we did the reconstruction back in 2020, we always felt it's really transparent, it's really fair to shareholders that trust us with their money. We're equally, offer them an opportunity to make sure they can exit at some point in the future at NAV. That's a small amount for costs. So we set it up, every 5 years there's a tender offer, 100% at NAV less costs. So that's coming up in June shortly. And the intention obviously is to continue that 2030 and so forth. The other changes that have been put in place is going forward, it's an income growth mandate. Going forward, there'll be an enhanced dividend. So the dividend today is 2.5% or plus or minus thereabouts. Going forward, it'll be 4% of NAV, say paid 1% a quarter. So increase in dividend there. We think that's a positive. Most of that can be met from revenue, but where it can't, we'll pay it out from capital reserves. One of the attractions about the financial sector is it's very cash generative, pays very attractive yields through buybacks and dividends. So if you start to add back up what the companies are doing on dividends, actually the underlying yield is much higher than what we'd be paying out anyway. There's been a change to the fee arrangement. So going forward, there's currently a performance fee. Going forward, that will be dropped. We'll be moving to a tiered management fee going forward, of which 50% of it will be based on the layer of NAV or market cap. So again, aligning ourselves with shareholders.
Super. I think actually something else that was going to come out here, but you were talking about very earlier, or sort of right at the beginning, you were talking about PCFT 1.0. Obviously, we're PCFT 2.0.
Yeah.
And obviously the next stage is going to be PCFT 3.0. I mean, presumably you've just covered all of the main aspects of what we're talking about with PCFT 3.0, or is there anything else?
No, I suppose the one thing we should highlight is that change in dividend policy does give us much more flexibility to tilt the portfolio towards slightly more growth stocks if we want, or vice versa. We happily go more into value high yielding stocks.
Yeah.
We don't have to buy something because we need to buy something for its yield, to therefore generate the revenue to pay out on the dividend. So that just gives a little bit more flexibility around managing the portfolio. And we think that's very helpful, should be very helpful going forward from stock picking.
It was in relation to that. You obviously financials are cash generative. Sort of sector tends to play also pay decent yields. And obviously the yield on the portfolio is going to vary depending on where you see the opportunities and where you tilt at any one time. But what's the sort of typical range? What would we typically expect the underlying portfolio be yielding? Or what's it yielding roughly?
It's a good question. I mean, historically, we've generated the underlying portfolio has been around 105, 110% or whatever, with them paying out once you take off costs for running the trust. That will move around. So that might be an underlying yield might have been in the sort of low threes currently. So what it does mean is we can shift more into emerging markets or payments or whatever. So that could come down into the high twos, the underlying portfolio, or maybe it can go. If it goes higher, then we don't have to worry about anything. It facilitates dividends anyway.
We've talked about the sort of enhanced dividend. I mean, what is the structure of that?
So the structure is it's 1% of the NAV every quarter. And that's going to that comes in place the start of the next financial year, which starts on the 1st of December this year, 2025. The new fee arrangements come into place, I believe, either beginning next month or 1st of July, or thereabouts. So go forward from there.
Okay. So while we're talking about sort of shareholder-friendly kind of features of this, a question here just asking about sort of how well or not management team are invested in this fund. And I guess presumably the other strategies, because obviously you're kind of aligned with those.
Yes, we all own shares. The live, breathe, love, hate, the sector 24/7. And yeah, I mean, I think what's perhaps surprising and people forget is the sector's compounded at about 9.5, 10% per annum over the last 10, 12 years.
Yeah.
So this is a sector that's been in the stocks for most of those 12 years, with mud being thrown at it, uh, negative interest rates, in some cases the UK banks, obviously the cost of PPI, etc., with a
Mm.
huge increase in regulation over that period, 1 in 100-year pandemic. I think that's quite telling. And
Yeah.
so going forward, yeah, that makes us pretty constructive.
Yeah. I suppose just on the regulation, obviously, Trump has made a big thing of sort of relaxing things, and clearly there's been a lot of talk for other financial centres to remain competitive. As we've hear a lot of people in this space complain about that the sort of pendulum has swung too far the other way, and there's sort of lots of very good examples of that. How oh, you said obviously you don't think anything is going to go back to sort of what it was, but how sort of comfortable are you that we're not going to end up sort of back at the Wild West? And I guess how do you navigate your way through that? I mean, to my mind, you almost want somebody looking at this professionally if you are worried about those kind of things.
Yes, I mean, the pendulum has moved by such an extraordinary distance. I mean,
Mm.
the most important thing is banks had insufficient capital, liquidity, and to take an extreme, they'd lend anything at a pulse, they'd lend money to. 2007. Northern Rock, it was doing mortgages at 125% loan to value. I mean, today with mortgage market, mortgage regulation,
Mm.
regulation on buy to let, and you have this is across not just the UK but many countries. People aren't talking about reducing capital requirements. It's more a case of the answers. If there's a question, the answer is not more capital every time. Some of the stress tests have never been very transparent, and this has been an issue in the US. Never quite sort of the logic of, okay, why is that bank, being hit by a bigger drawdown on its capital under stress scenario, X or whatever. And so it's just being a much more collaborative, thoughtful, thought through way. What's good both for the financial system from a stability point of view, but facilitates banks and other financials as being the intermediary between savers and borrowers, those that need to invest and those who have money to put away. And so, as we all know, there's it's a minefield. It's an alphabet soup of acronyms that's meaningless to people outside the industry. Ring fencing, the latest one in the UK, question marks about that, all done with good reason. Does it actually make the system any safer? So all those things I think are worth being reviewed.
Yeah, that makes a lot of sense now. Just going back to the sort of sheer diversity and how actually this is obviously, very different exposure to just buying yourself a sort of bunch of banks. We've got a couple of questions on specific stocks that I'd quite like to explore, but the one that stood out that a lot of people keep telling me is a sort of very good company, maybe, maybe not, but I saw on the slide here was Mercado Libre. Um,
Yes.
Explain the rationale for holding that.
Yeah. Um, uh, Not a company I know in fine detail because a colleague covers it, but basically, Mercado Libre, to put it simply, is a sort of the Amazon of Latin America. It has not dissimilar, it has a payment system, ecosystem that's connected to that. And it's that growth in that payment system is why we like it. And it's just that what you've seen is those companies that have been able to provide just fantastic customer user experience. Particularly in some emerging markets, they're much more oligopolistic. Maybe some of the incumbents have been a bit slow to react to the change and the opportunity of, using the internet, digital, online banking and so forth. So, they've been able to do that exceptionally well. And
Yeah.
so that growth there, using that platform to also lend to customers, has delivered, delivered very, very good growth. So that's why we like it.
So a question kind of related to that. So sort of out of interest, do you hold any Revolut? I mean, maybe, I don't know to what extent you can talk to that or not. But do you guys have a view on it if you can't?
I mean, it's been a fantastically successful company. We were not. I suspect at some point they might come to the market. There's a few others like Starling and Klarna. We talked about IPOing.
Yeah.
Also, Klarna IPO, I assume, has been pulled with the market
Yeah.
volatility. These are all really great businesses. But Klarna valuation, I think we had an opportunity to invest when it got to $30 billion. This is back in 21. Then raised to 40. It got down to 5.
Yeah.
The last number I had was 15. That's a different beast from Revolut. Revolut's, generating good profit. I know the accounts have come out recently. I haven't had a chance to look at it. But, I use it. It's a great app. I think the interesting thing is when they launched, and the same with Monzo and Stripe, people thought they'd materially disintermediate some of the incumbent banks in the UK.
Yeah.
But that hasn't happened. The incumbents have caught up, proved their user experience, their digital offering on their banking mobile apps. Apart from maybe better FX rates, or maybe if you want to trade crypto, which is the attraction of using River, it's a different beast to your NatWest or Barclays or whatever. So it's something we'd certainly look at, if and when it comes to market. But otherwise, we don't have any other real insight into it.
Yeah. Because when we were talking about the sort of private assets earlier, obviously you're holding listed assets. You're talking about sort of asset managers that invest in these spaces,
Yes.
sort of being a very much a sort of growth area. Probably one other sort of stock related question. We'll move on. It was the interest in Sumitomo Mitsui Financial.
So that falls into the sort of rising interest rates is good for all things financial sort of bucket. I mean, Japan is the poster child for negative interest rates and low growth for the last couple of decades. So they're similar to some of the European banks were sort of crushed out of existence. So interest rates come down, so banks can make very, very little money. Difference between what they pay out deposits and what they're charging for loans. So we've owned a few Japanese banks. We pulled back a little bit in the last few months as interest rates have been going up in Japan and the 10 years risen, margins expanded. So suddenly they're making more money and the share price has risen on the back of that. And so fundamentally, it's a play on that. Long term, we think there's much more interesting stocks once, I suppose, some of the macro moves and interest rates start to peter out, as we expect they will over time.
Okay. I'm conscious of time. I think we're sort of coming out the hour or so. So I guess so before we wrap up, really, particularly with PCFT 3.0, very much on the horizon. I mean, kind of why financials and really sort of why PCFT now, if you could just wrap that up for us.
Yeah, absolutely. So, my financials ultimately, it's a changing investment landscape, we would argue. So interest rates have gone from the extraordinary zero and negative levels that we had, in the 2010s to a more normalized level, whatever that is, 2%, 4%. In that environment, financials, that's banks and insurers, make good money. There's a need for loan growth to come through, whether that's for defense spending, infrastructure, the green transition, reshoring, whatever. The financial sector is going to be the conduit to which a lot of that is facilitated. They'll benefit from that. And you've had a sector until the last couple of years has been very out of favor. You've got tailwinds around more sensible regulation, perhaps artificial intelligence and automation reducing costs, democratization, investing growth of private market. There's some really interesting trends there which you can take advantage of. And then why PCFT? Well, in a sense, as with any other fund, it gives you that wrapper to give you that sort of lower risk exposure to the sector. With us, hopefully, picking the best stocks or timing our shifts into different markets well. And there's some interesting stocks and opportunities within the structure of the trust. We can use gearing. We haven't in the last year to any degree, as markets have been, a rip. But we've got that facility again to increase returns. So you've got, we think, a really good vehicle. You've got transparency around the ability to around regular tender offers, which should keep the discount in and volatility of that discount reduced. So we think that's fair. We've got a reduced fee on top of that. Hopefully that means we can continue to deliver good returns to those that are shareholders and want to entrust us with their money, which we're always grateful for.
Well, look, thank you, Nick. That's been really sort of super update as always. Really look forward to sort of seeing PCFT 3.0. I should say, I mean, I've kind of liked all the iterations. I always thought it was a really good idea to begin with. It does something different. And I kind of like the way that it's moved with the times and try to do sort of, increasingly good shareholder sort of friendly things with sort of each iteration. So hopefully we'll get you back in another year or so. We'll find out how you're doing.
Yeah.
Beyond that, and just to thank Andrew again and just draw everybody's attention to the disclaimer. Obviously, these are important. So if you could take a moment, if not now, maybe later, just have a look at that. And then sort of finally, just to let you know, we'll be back next week when we will have Mark Shepherd from Manchester and London, who those that follow it will know that he's very much focused on AI these days. But thank you all, and I say we'll see you all again next week. Bye for now. Have a great weekend.
Okay.